Adrian Mowat joins us, emerging market equity strategist. Adrian, fantastic to have you back and thank you for joining us. Adrian, for a market which was struggling till about 2 months ago, 2.5 months ago, everyone wanted to only buy after the Indian elections. I guess foreign institutional investors have surprised us with their commitment. Why is that India has become the only pretty girl in the town suddenly?
Well, I don't think it's correct to say that India is the only game in town in emerging markets. We've got a broad emerging market rally going on, which started as a recovery trade at the beginning of this year, where India did not participate, as India had been an outperformer at the beginning throughout 2018. Now, what I think is going on and explaining why you're seeing good inflows from foreign institutional investors is simply that there are strong inflows into emerging market funds, particularly ETFs, and India is getting its share of that. So I think that is the dynamic that's going on here, rather than people buying specific fundamentals in the Indian market. This is more of an EM trade rather than India trade.
Given that though, Adrian, do you still feel that the macro situation is perhaps, a better position currently when it comes to what you're seeing in India?
Yes, so I think what has changed, and this is a global theme, is throughout 2018, the focus was central banks tightening, particularly the Fed tightening, but you were also getting a tightening bias being assumed in emerging markets. In India, which is also the case of what we saw with the Fed, you've had a central bank going from a tightening bias to now an easing bias, as you've been discussing earlier in the program, strong expectation in the market that the repo rate is cut in today's statement, and probably you see another cut and maybe the repo rate finishes at something like 5.75. So that is definitely better. If we can get continued economic growth in India and a central bank that's dovish, that is bullish for growth assets, which is why you're seeing an equity market rally in India, and you're also seeing a powerful equity market rally in the United States at this point.
Adrian, how critical to all these assumptions is the fact that the current regime or the current government comes back to power, because this month we're going to kickstart the important process of elections, and by May 23rd we should hopefully have a government announcement as well. Do you think this is a key risk to the inflow of flows, FII money pouring in?
I don't think it's a risk to the ETF flows. In that these don't look at the politics. These are just simply looking at the EM trade, looking at that as a growth risk asset. Now, is it a threat to the economic outlook of India? I would suggest that it might be a modest change in economic policy, but India tends to be a sort of robust, consistent growing economy. It's an economy that will continue to benefit from the reforms that have been put in place by the current administration. So I would imagine the economic impact of a change in administration would be relatively modest.
Adrian, if one works with the assumption that the current administration comes back into power in the current avatar, so the critics would argue, big deal, what will change? What has happened to growth, what has happened to policy, what has happened to various government initiatives, what has happened in last 5 years, we may see an extension of another 5 years. And last 5 years, frankly, from an earnings standpoint, have not been very gratifying. So whereas a stable government is great and good, but a stable government in last 5 years have not really taken the Indian economy or the Indian earnings trajectory to a different orbit.
Well, I think that's a very fair point, but it's important to understand that there have been some challenges out there. The implementation of GST is a very good long-term structural reform. It causes near-term disruption. We did have demonetization, which also caused disruption. We've had globally a significant slowdown in EM economies, particularly China. You've also had disruption of the EM story as the Fed was raising rates, and you saw weakness in EM currencies, which India was part of, and that then provides further headwinds for the Indian economy through an expectation of higher inflation and higher interest rates. So I think the administration has done what it can do in terms of reform, but it lives within a global economy, and the global economy has been throwing out challenges.
Adrian, it is often believed that global flows are a function of local events, stability and safety of money, and earnings prospect. Now, we've looked at FII flows into India from 1992, and there have been only 3 instances when foreign investors have turned net sellers, and that had nothing to do with local events. That had everything to do with global events like tapering and 2008 financial crisis. So how should one read into it? You know, at a time when Indian markets are dependent on global flows, and global flows have not moved even irrespective of the election cycle or the election verdict. Do you think there is no real one-on-one correlation between flows and election cycles?
So there isn't, because you've done the work. When you think about what foreign investors are doing, I think you've got to look at their relative positioning. So if you look at an actively managed EM fund, are they adding to their weighting in India or reducing their weighting in India? And that will give you more of a clue about the relative fundamentals of India versus other markets. The issue in looking at simply FII flows is that you will get the macro trade, which is, are people adding risk in EM or taking risk out of EM? The other thing that's very important to remember is at the end of every trading day, there aren't any more shares in the market. If a certain type of investor has been a net buyer, it means that another type of investor has been a net seller. And so the types of sort of structural issues that are important when looking at this is, if you're measuring from 92 onwards, remember that FII registration only really started late 1993. So the market was closed. Access started to open up. It was very bureaucratic. It took a long time to get your approval. So India has been structurally increasing its exposure in global equity portfolios. You also need to look at some local factors. There was mis-selling of insurance-linked equity products running into the global financial crisis. You then had a significantly large decline in the assets of insurance companies in equity markets in India. So effectively, you had a structural seller of domestic institutional investors, and that had to go somewhere. And where can it go? It either goes to retail or it goes to foreign institutional investors. So those types of dynamics, I think, are often much more important than worrying about the near-term macroeconomic data or even medium-term macroeconomic policies from various administrations.
What about some of the risks to the India story? I just want to take the conversation a little further in terms of time. We've been talking about the run up to the elections. We have had a lot of commentary coming in from FIIs who've been re-looking at their portfolio structure, adding to it, as you just said as well, looking at perhaps where money can be taken off, where it can be added, and what they're anticipating. Would it be too early to sort of suggest whether this is a sustained rally that we'll see even post-elections, assuming a steady result or a favorable result for markets as they're anticipating?
Yeah, I think that's a really good question, and I think it can be a sustained rally if the global backdrop continues to improve. So that the thesis for a continuation of the global bull market is that we finished 2018 with extreme level of pessimism around global growth, people talking about recession, much focus on a very distorted bond market and an inverted yield curve. And we also had an expectation that the Fed would continue to raise rates. Now we've moved into this environment, which we're already talking about, in that we now have generally dovish central banks, even some talk about the Fed easing in some way. And I think you're also got an environment where the macroeconomic data will be at its poorest from the first quarter, is now beginning to stabilize, and will be improving relative to expectations for the balance of the year. So that comes through from the US. It also comes through from China as well. And if that is the case, then equities will perform very well globally. and India will benefit from that. It's quite difficult at this point to see an India-specific delta that would attract capital for an India-related story. I'm very struck by the performance of the Indian equity market at a stock level. This doesn't, to me, look like an India trade. It looks like a very stock-specific trade with essentially portfolio managers adding to what they already have. There's a big dispersion of returns. You know, if you've been in Yes Bank or Axis Bank year to date, it's been terrific. But if you've been in something like India Bulls or Tata Motor, Mahindra, you're actually down double digits year to date. And so I think this is very much the portfolio managers adding to their existing stocks that they like, rather than a big India macro trade.
Construct three scenarios, and I'm again going back to the election. Just bear with me for one more question on that. There are three possible scenarios. One, current administration comes back into the current avatar. B, the current administration comes back but with the outside majority. And third, there is a complete change of the administration. To your mind, which scenario do you think Indian markets are pricing in? What is in the price and what could shock or surprise the market?
I think the base case, what is in the price, is a continuation of the existing administration. There would be downside in the market if you end up with sort of hung parliament or a change in the administration.
You know, I just want to go back to the point that you were earlier making, that elections at best is a very modest event in terms of a policy stance that FIIs would look at. Because just yesterday, or rather day before, we had the opposition Congress party release its election manifesto, and there were a lot of poll promises, as typically the case would be. And one would think that if these policies were to be implemented, if they were to come to power, this is going to have a huge fisc burden to it. Do you not believe that the governments right now run a risk because of the poll promises to really burden the fisc?
Well, the answer is yes, if they carry forward on what they're promising the electorate. It wouldn't make Indian political parties unique globally if they overpromise their electorate ahead of a general election. So I think there's maybe a level of cynicism by the investors who just assume that the politicians are promising something that won't ultimately be delivered, because when they get into power, they will recognize their fiscal responsibilities and how the market will discipline them. You know, India runs a current account deficit. It has a fiscal deficit. It's got to be very careful about maintaining sustainable policy.
Adrian, hypothetically, if markets fall, if they're not very happy with the election verdict, do you think that could be a buying opportunity, or you will have to do serious deliberation and thinking about the political mandate and then only you will come up with a view?
Well, we've got an analogy here. We have experienced a surprise defeat of a BJP government, a sharp fall in the market. And the lesson was that the Indian economy is a huge juggernaut, and it just tends to keep going with its momentum, and the earnings impact, the growth impact of the change in administration proves to be very modest. So yes, if we had a surprise political event that caused a correction, I would definitely view that as a buying opportunity.
In your mind, what is the relation between economic growth and markets? Is there a direct one-on-one correlation, or market positioning and economic growth are two separate things? It's about levels and it's about valuations.
Yes, so if you look at the US stock market and US nominal GDP growth from the Second World War, you tend to get the top line growing with nominal GDP, and ultimately the top line growth rate will determine the bottom line growth rates. So I think nominal GDP is important. Now, that's for the US economy and the stock market. When you start to look at the smaller markets around the world, the emerging markets, they often have quite a polarized sector composition and may have a lot of exporters in them. So you then need to also think about currencies and macroeconomic policy, which might include having a lot of industries nationalized and therefore not represented in the market. So nominal GDP is an important strategy factor to think about, but currencies are also incredibly important in emerging markets.
Adrian, you know, what are the chances that we may not actually see much more of a movement in markets because they've already had that rally in anticipation of a recovery?
Yes, so I think that's a very important point that we had a terrible final quarter of 2018. The first quarter of this year has been a recovery rally in global markets. And as we were highlighting earlier, India didn't really participate in the first 2 months of the global rally because it didn't do too badly in 18. I think for a sustained move in markets, you need to continue to have dovish central banks combined with an improvement in macroeconomic data so that people have a confidence that 2020 is not a recession year. If that comes through, then I think global equity markets will continue to move higher and India will participate in that trade. So we need to really be looking at this high frequency macroeconomic data in order for these markets to continue to move ahead.
Adrian, markets will always reward investors if there is scope for earning expansion and P expansion. I mean, that's the ultimate lethal combination anybody wants. You know, prices go higher and P multiples or book price to book, it gets re-rated. Where is scope for this kind of an move in India now?
Absolutely there is, because if you think about PEs, you need to consider two inputs. One is growth and the second is your discount rate. So as I was sort of answering the previous question, the uncertainty really is around growth, which will ultimately be a factor of looking at the macroeconomic data. What we do know is that discount rates have moved meaningfully lower from the peaks that you were seeing in 2018. So that is a very powerful justification for a PE re-rating. I think India's on about 18 times at the moment. So, you know, above its 10-year average of 16. But we did see the market rated at 20 times in August last year. So I am of the view that the PE multiple for global equity markets is going to move higher. And I think that'll also be the case within India.
Adrian, what is your general view on cyclicals? When I say discretionary, part of the market, especially autos, there is pain there. But if interest rates are coming lower, do you think demand and comeback could also be equally sharp?
Yeah, a very important question, because autos have been a significant underperformer in India, but they've also been a very significant underperformer globally. We've got a recovery in the Chinese economy, yet car sales are still very poor. The auto numbers out of the United States that were published earlier in this week were also down year over year, even though that economy looks strong and the household sector has good income growth. And what we've got in the auto sector is a structural change brought about by technology. So there is demonstration through the likes of Tesla. You'll see more manufacturers. Ford announced a lot of new electric vehicles this week. Porsche coming out with a very competitive, obviously very high-end product, but that'll go down through the rest of the Volkswagen group. So we know that you're going to have electric vehicles that will be affordable at some point in the future. And the problem today is if you have a car and you're thinking about replacing it, you don't really want to buy another internal combustion engine car. You want to wait for an electric vehicle that you can afford. So the story is going to be an extension of the replacement cycle for the auto industry. And India auto industry will suffer from that as well. Maybe not as much as a developed country because the penetration rate is lower. So I'm cyclically, I sort of want to buy this sector because it is a good representation of your consumer discretionary sector, but structurally, I'm very, very wary of buying it because of this technology change. I mean, just to, to highlight the analogy, go back to thinking about the TV you used to have in your living room. It would have been a CRT TV you're watching the cricket on. You would have gone and seen a flat panel TV, maybe somewhere in a shop, thought this is too expensive, but I definitely want to replace my TV with one of those. And so you let the replacement cycle for your existing TV run until the price point came down and you replaced it with a flat panel TV. Exactly the same thing's going on in the auto industry. And so what you're going to have is companies with a huge amount of stranded assets, which were put in place to build something that was old technology. So that's a very long answer. I want to find cyclicals in India, and maybe I'm better looking at cement and steel rather than looking at the auto sector.
Talking about EVs, we also are waiting. When are they going to hit the mass markets here in India? But Adrian, what other than autos? I know you've always been a fan of banks, and we've really seen that banks have led the rally in this past leg. But do you think it's time to broaden or deconcentrate, if you will, your portfolio within banks? Is it time to move to PSUs now because maybe there's higher alpha generation scope there?
You see, I think you're still better off maintaining your high quality portfolio in the banks because the long-term story is that the PSU banks are short of capital. Their recapitalization has been inadequate. It means that they can't grow with the overall banking industry. It also means that you've got the private sector with this very nice competitive landscape where the largest part of the market in terms of deposit base is constrained. So I think you've got to stick with private sector banks as a core part of your portfolio. I think it's also important to remember, when you're discussing PSU versus private, is as a percentage of free float, private sector banks are much more significant than PSU banks.
Fantastic to have you back, and certainly hope to see much more of you going forward.
Thank you.